do is recalculate it. Great. So I hope this has made a little bit of sense. Again, what we're just trying to do is we're just trying to find a way to say, well, how do we identify and calculate this beta? And this is one way of doing it. It's called the pure play approach. And you know, if you get a small question on that, it's marks for jam. Okay. Great. So what I'm going to do is quickly do a 5-minute recap of the things we've done to make sure that everything's clear, and then I may just take a short break and then you come back with an example and move on to WAC. So the first thing we spoke about is just the portfolio theory. And this is just the risk-return relationship. Again, you've got to live and breathe this stuff. It's really exciting. Risk and return. For a given level of risk, I'm going to expect a certain return. How does that model out when you've got a couple of assets? This is called the efficient frontier. And when you incorporate a risk-free asset, you're looking at the line that creates a tangent with the efficient frontier. Okay? From there, we then said, well, great, we know this. But then how do we calculate the returns of different combinations of a risk-free asset and a risky asset? And that's where we got to this formula here that basically started saying, well, with different combinations, if I had 50% in one asset, 50% in the other, and they had different returns, how do I calculate the return? And very simply, the formulas are given to you, you're calculating an average of that, the weighted average. And for the risk, again, you're saying, well, I've also got to calculate the volatility or the risk of my portfolio. This is exactly a similar thing. Let me just write this formula for you. Make sure that I've got it here. Sorry, here it is. Again, that's the risk we're talking about. So we're saying, how do we calculate the risk? What happens is if you have this formula with an asset that isn't seen to have risk, well then obviously the risk for that is 0. So you simply get the risk equal to the weighting of your risky asset, times the volatility of that. So it'll be the weighting of the risky asset times the volatility. Because if I combine a risky asset with a risk-free asset, but then I assume that the risk-free asset, the risk is actually 0. What that'll do is this will be 0, that'll be 0, and I'll just be simply left with the weighting and risk of my first asset. And when you hear about this term volatility, all that is it's the square root of the standard deviation of your portfolio. Then what we spoke a little bit about was just saying that how do we, we spoke about diversification and saying, well, if we add more assets to a portfolio, what happens to the risk? And what this chart will study is that as you add more assets to a portfolio, your diversifiable risk decreases. How much it decreases is dependent by how correlated the assets are. If they are largely uncorrelated, so they move in opposite directions, as you add more assets, your diversifiable risk will decrease a little bit faster. And ideally in South Africa, again, I said 30 to 40 stocks is probably the portfolio that will most diversify your risk, or suitably diversify your risk. And once we said, so now we've diversified and we understand a little bit about, you combine a whole bunch of assets into a portfolio, but how do we measure then just that systematic risk? So once we've diversified our all the unsystematic risk. We're left with this market risk or systematic risk. And this is the beta. This is what we're trying to measure. We're trying to measure how risky is my asset in relation to the market. And one way of doing that is just you simply regress the returns. And that's what we spoke about briefly, is saying if I take the expected return here we go. If I take the expected return on the share and I regress it against the market, what it's going to tell me is how risky my asset is in terms of the market. Very key and a very simple concept as well. The slope of that regression line will be your beta. Then finally after that we spoke a little about, well, if I don't want to do regressions on this, what's another way for me to calculate the beta? And one of the ways is actually to just use the pure play approach. And the pure play basically says I'm going to find comparable companies. I'm going to their assets are likely going to have the same risk as my assets. That's why they're comparable. And I'm going to remove the effects of their capital structure and just get left with the risk of the asset. Then I'm going to apply my capital structure to that. And that's the process of levering and unlevering the betas. So we spoke through it. You identify your pure play companies. You then unlever the equity betas. And you get left with something called the beta on the asset, the risk of the assets. Then what we do is we find our target debt ratio and we go through a process of just very simply relevering that beta so that you end up with the risk, the systematic risk of my firm. And so that covers a little bit about risk and return. And I'm just going to take a little break and then we'll come back and speak about WACC.